Hey, YouTube. Let me just turn the mic up here a little bit. How's everybody doing today? It's another week of live streaming. I have a lot of information for you today. Just give me the thumbs up. Make sure that I'm coming through loud and clear and that you can hear me. I've seemed to have sorted out the technical issues from last week, so hopefully won't have any problems with the stream freezing this week. And I'll be able to give you all of the information that I have for you this week, which last week I wasn't. I apologize, but you know, I'm not a technical wizard and I'm still sort of figuring out this live stream. So I see a lot of people on the stream, as always. Let me know where you are this evening in the world. I'm still here, stuck in sunny Florida. It's not such a bad place to be stuck. But you know what's interesting about that is I was thinking about when would I actually feel comfortable getting back onto an airplane to come back to the UK. And I think even if they gave the all clear with the coronavirus today, I still wouldn't necessarily be hopping on an airplane within the next week, 2 weeks, even a month. There's definitely that fear that has been instilled, you know, by the media and whatever your thoughts are on this virus. Even if things do get officially opened up today, how long is that going to take for people to really feel comfortable? And I know the lockdown in the UK is a lot more severe than it is here in the US. They've already started to open things up. On Monday here in Florida, they've started to open non-essential businesses, which I think personally is too early, but we'll see how that works out. So we'll just do a couple of hellos here. AC chat, how are y'all? Get to your questions. If you have questions, just pop them in the comments. I'll try to get to all of them. Have a lot of information today about Assets Capital. I have been on a call with them yesterday with CEO Stuart Law. I had a Zoom video call with him for about half an hour, so we've got a lot of good information from him for all of you Assets Capital investors. And you know, we'll be talking about Lendy, the situation, LoanPad, Rate Setter, that beautiful rate cut that we saw this week. Let's see, Growth Street. And then we're going to talk a little bit about the stock market and what's going on with that. And also about my new Facebook group that I've started up. It's a closed Facebook group, totally free to join. I'll be putting the link in the description if you want to join the Facebook group. You can interact with me and you'll follow peer-to-peer lending or financial investors. Go ahead and sign up and I'll add you personally. It is closed, so I don't get a bunch of Chinese spammers or maybe Russian spammers. I don't know. Not to be stereotyping any particular culture, but yeah. So go ahead and join the Facebook group if you're so inclined to do so. We're going to have a lot of good information in the group about peer-to-peer lending. So let's see who else we got. David here. Mr. Hi Smith, John. Hi, John. David Kennedy, Alan. Good evening, Alan. Chicka Boy. Your nickname always gives me a bit of a kick. It makes me laugh. Hi, Dominic. How are you? Peter. Paul. Hi, Dale from Bristol. A place near and dear to my heart where I actually went to boarding school in Clifton. So, you know, I've always got a bit of a soft spot in my heart for Bristol. Hi, Martin. You're stuck in sunny Leeds. Come on, Leeds is a wonderful place to be stuck. You know, probably a better place than Grimsby, but I wouldn't mind being stuck in Leeds. Dominic in Coventry. We got Lincoln, Kenilworth, Norfolk. We got Debbie from Spain. ¿Cómo está, Debbie? That's my very small amount of Spanish that I know. Please go ahead and give me a thumbs up on the like button because it helps me with the YouTube search. Penny or something like that if you give me enough likes. Probably not, but hit the thumbs up if you're enjoying the stream. Hopefully, if you're not at the moment, by the end of it, you will, because my goal is to give you a ton of value, about peer-to-peer lending and general investing. So that's it. Hi, Keith in Lincoln. Mr. Smith says the virus is a con. Yeah, it could be. Who knows? I don't know about that, but I do have some thoughts about conspiracy theories. But Lancashire. I think you have good cheese up in Lancashire. Okay, John's in Nottingham. We're stuck in Essex. Can't get back to Crease, Robert. Well, there's worse places to be stuck in, I think, than Essex, right? Maybe. I don't know. I've never actually been to Essex, so can't be that bad, right? Let's see what else we got. Chris, Philip and Milton Keynes. Hi, Kerno Flow. I heard something about Kerno Flow. If that's your nickname, what did I read? Maybe it was something else. It's like some kind of self-help thing that looks interesting with exercise and mental well-being. But I don't know if that's what your nickname means. Maybe that's your name, Kerno. Hi, James. So Kerno's in Cornwall. We have Brian from Woburn, just up the road from Captain Tom. Yes, hi, good evening to you, Brian, Tony, and Hove. Sue, hi, Sue, in the North Midlands. You fled your apartment in Tenerife. That might be the only time that somebody actually flees from Tenerife to go back to England, right? I mean, certainly not because of the weather, but COVID is a good reason to flee from Spain. James in Manchester. Hi, James. And we got Paul in Portsmouth. One day we'll return home to West Palm Beach. Paul, you're West Palm Beach, huh? That's interesting. Hi, Scott from Aberdeen. Sure, I did reply to your email today, Scott. It took me a couple of days, but if you check your inbox, there is a reply in there, and I will talk about what it is that you wrote in your email. Hi, Colin from the Peak District. So yes, thank you everybody for joining me on the stream. This is something that I do every Thursday night at 8:15. It gives you a chance to bang your pots and pans at 8 p.m. in applause of the wonderful National Health Service, who are doing a wonderful job despite their financial challenges. That's for another conversation. But yeah, every Thursday at 8:15, God willing, and I'm healthy enough to do it, I will be here in front of this Logitech webcam and this big blue microphone to give you lots of information about investing and to answer your questions about peer-to-peer lending, and whether you have questions about stock market investing or Bitcoin or gold, and I'll definitely give you my opinions on those. So let's go through. We'll answer some questions, and I'll give you the information that I have here on my wonderful Word document, starting with Assets Capital and my interview with Stuart Law yesterday, which I was very comfortable with. I felt I got a lot of good information from it, sort of eased my worries a little bit about. I didn't really have too many worries about assets, but Stuart has a very good understanding of this economic situation and COVID, and assets plans moving forward seem to be very solid. So, excuse me, I'm going to give you the information about assets and what I learned. Probably not too much that you haven't already learned on the email that was sent out, but I do have some other things that Stuart and I discussed. So AC says, hi, Lawrence, just wondered what your thoughts were on the recent rate cuts at RateSetter. I can't believe they've halved them, but I guess it's better than them going under. I mean, I can believe that they've halved them, and I think you're going to see other peer-to-peer lending companies following suit. You're going to see rate cuts for most of the peer-to-peer companies. If you think about what's going on in the economy, people are losing their jobs, and people are losing their businesses in some regards, and they just don't have the money to make these loan payments. And RateSetter is primarily made up of consumer lending, which is people borrowing smaller amounts of money to buy things like televisions, go on a holiday, make car payments, and unsecured. They're unsecured borrowers, and those people are going to be the ones that I think are ultimately going to need that forbearance payment holiday first before, say, a property developer or necessarily a business would. So it doesn't surprise me. Of course, it's disappointing, but it's not. It's just not a surprise to me. I wasn't surprised at all. I didn't think it would be 50%, but what I'm very interested in, and I did receive an email about this asking me, is RateSetter actually contributing? And for those that don't invest in RateSetter, what's happened is they've basically cut their interest rates to lenders by 50% until the end of 2020. Now, they are going to review that every 30 days, but I would expect that you're going to see low rates for definitely maybe until Q3, probably Q4 of 2020. But what's happening is they're reducing the interest rates from lenders, so RateSetter can contribute more money to the provision fund, which covers lenders equally. So when borrowers default or are late on their payments, the provision fund will make payments to lenders equally. And this is RateSetter's main business model of how it works, rather than if you were to get an individual loan from another peer-to-peer lender, and that particular loan defaults, you are usually not covered by a fund like that. So the provision fund is designed to cover all the investors equally in RateSetter. What they're doing is cutting the rates by 50%. So if you are being paid 4% interest, you'd now be expected to get a target rate of 2%, and that extra 2%, theoretically, of interest payments will be used to pad the provision fund, an expectation that defaults from unsecured and possibly secured borrowers will start to rise. You will see more late payments, just inevitable what's going on in the economy, and that provision fund needs to be padded and bolstered in order to pay out interest to lenders. And what they're trying to do is to keep that interest rate at a okay percentage. Of course, making 2% isn't great, but it's better than zero. And I think ultimately, like you said in the comments, it's better for them to do that than to have RateSetter turn into a financial disaster. So going forward, what do I think about RateSetter? It's definitely concerning. I'm not going to lie. The provision fund is going to get depleted at a far faster rate because of what's going on in the economy. Does that mean the RateSetter is going to be in financial dire straits? I don't know the answer to that question. I would hope not. I think they're well funded, but I certainly wouldn't fault anybody for wanting to try to exit out and just sit on the sidelines until this mess really runs through. Now, there's a lot of things, I think about, and sometimes loyalty pops up into my head. I've been investing through RateSetter ever since I began peer-to-peer lending, and I feel like I have this sort of devotion of loyalty to stick by them and help their business survive. But at the end of the day, money is money. It's not your responsibility to make sure that a peer-to-peer lending company survives or not. It's your responsibility to be a custodian of your resources. And if you feel like sitting out of a peer-to-peer lending company for the next 3 to 6 months because that's the least risky thing to do, then by all means, go ahead and put in that sell order to exit and pay the fee. I've done it. My general feeling is on RateSetter, I've decided to exit some of my investment and pay the fee, and normally I wouldn't do that. But I just get this uneasy feeling about why take that extra risk when it comes to RateSetter and seeing what's happening to the provision fund. If I get some further information about that, I'm planning on having a chat with hopefully the David Battersby or Mario, who is one of the executives there, and see if they can give me some more information about what is going on at RateSetter and how they expect this provision fund situation to play out. But I'll be discussing more about RateSetter a little bit later in the stream. So David said LoanPad have also cut their rates. Yes, LoanPad cut their rates by 0.5%. I'm sticking with them. I think that, again, they're just taking proactive measures to stay competitive. What you're going to see is the competitiveness in peer-to-peer, especially with now the introduction of the CBILS loans that the government are offering, will inevitably make peer-to-peer more competitive. So LoanPad is one of the companies that's saying we're going to cut our rates by 0.5% just to stay competitive. I personally believe LoanPad is a place where I'm going to leave my money for now, and I don't have any problem with them cutting the rates by 0.5%. And to be honest, look, I'd be happy to get 0% at the moment just to get my capital return. In the long run is what I'm concerned about. We've never seen an economic situation like this before. So to be thinking about trying to get interest at a time like this is not really on top of my list. Of course, would I like to make money on my investments? Of course. But more concerning, I want to make sure that capital is preserved, because capital losses are something that I have experienced before in the past, not only through peer-to-peer lending, and I think capital preservation is a big deal. So, I'm sorry, Aki. I will pronounce your name Aki Chap, even though I may not remember that's the case next week, so you have to remind me. John says, hi all, any thoughts or benefits to retail investors of assets CBILS accreditation? Yes, so if you're a investor through Assets Capital, you'll have seen an email this week saying that they have become one of the accredited investors, the accredited loan companies that can lend to CBILS, which is the government's coronavirus loan assistance program for businesses. That basically what it does is it allows business to have their interest payments made by the government for 12 months and gives businesses an access funding line to get them through this coronavirus situation. Funding Circle, one of the first companies to start offering these CBILS loans. And the problem with these CBILS loans, I probably need to stop talking so fast. I just have a lot of information to give you, but the CBILS loans cannot be invested in by retail peer-to-peer lenders like you and I. So these Funding Circle loans you and I cannot invest in, and any CBILS loans that peer-to-peer companies are offering, you will not be able to invest in because that's the law. Now, one thing that came into my head, and I emailed Assets Capital about this today, and they were very quick to give me a response. And I said, well, look, Assets, now you're one of these CBILS lenders who you can loan them from 250,000 up to £5 million for business. You have access to this funding now. What is your advantage to offering retail peer-to-peer loans at this point? Because if I'm looking at it from a business perspective, the CBILS loans seem like a no-brainer. The government covers up to 80% of the loan, so the peer-to-peer lender only has a possible risk of a 20% portion of the loan. And getting 12 months of interest paid by the government is a massive advantage for the peer-to-peer lending company. So what would be the advantage to a peer-to-peer company at this point offering normal loans? And what the answer to that is, not every business is going to qualify for CBILS lending. And the rates at the moment, I think about 50% are being approved. So there you've got 50% who are not being approved and still need access to lending. Now, out of that 50% that is not being approved, a good portion of that probably wouldn't qualify for lending, whether it be through retail peer-to-peer lending or just through the high street bank. So there is going to be a percentage of those 50% that wouldn't qualify for any type of lending. But there's also going to be a good portion of that 50% that didn't get approval for the CBILS loans who are going to need access to lending. And a company like Assets Capital is going to be able to continue to offer retail peer-to-peer lending to those businesses, which is a really good thing for you as a lender, because it gives you the opportunity to know that there will be new, fresh loans coming into a company like Assets. Hopefully they have the manpower to handle not only the CBILS loans, but the peer-to-peer lending loans too. This is probably going to mean some kind of an expansion for them with regards to staff and being able to handle these loans. So I generally think, if you had 100% approval on CBILS loans, obviously what peer-to-peer company would do retail standard loans? They wouldn't. They'd just do the CBILS loans. But since there isn't 100% approval, since it's more probably at the moment is 50%, but I would see it reducing maybe to 40%. That's going to leave a 60% decline rate, and there's going to be a void of lending that is going to need to be filled by people like Assets Capital and other peer-to-peer lenders. So, yeah, I think that's my take on this UBILS and assets. So, let's see. Highsmith says, "Is peer-to-peer going to survive this?" I think there'll be casualties. I don't know particularly who. I think there's going to be business casualties, not only in peer-to-peer, but it's just a tricky economic situation that has many ebbs and flows. And I think it's going to be about cash burn rates for peer-to-peer companies. Can they survive? Do they have enough cash to get them through the survival period? One thing about Assets Capital is Stuart Law, CEO, told me yesterday was, that they are currently running a break even. You're going to see companies that are able to get to that break even point, and they will probably have to introduce some ways to generate extra fees. Assets Capital did it with the temporary 0.9% management fee, which I do know will be temporary, but that kind of extra bump in their revenue will get them through this situation. So yeah, Highsmith, in answer to your question, I do think peer-to-peer is going to survive, but I think there's going to be some definite negatives and some setbacks that any finance company is going to experience through this economic time. Let's see, David, have you any information on whether talks about a merger of British Airways with American Airways is being discussed by Donald Trump in trade talks? Nope, I don't have any information about that. If you look at the news, though, Warren Buffett sold pretty much all of his airline stocks in the last week. So, he's one of the greatest investors, I think, of our generation, the generation before. And if he's selling all of his airline stocks, I think he sees the airlines are going to have a bumpy road for the next 2-3 years to come. But no, I don't have any information on American Airways. I definitely not somebody that invests in airline stocks. So I think it's pretty risky. So let's go through the questions here and see what else we got. Kika Boy says it's too dangerous to get on a plane. Don't do it. Yeah. Some of that airplane food is very dangerous too to eat. Yeah. That might be more dangerous than the coronavirus. People get sick from the food on those planes all the time. But actually, airline air circulation, they recirculate the air every 10 minutes. So it could actually be healthier sitting in an airplane with all of those people because the air is getting circulated than being in, say, a pub. And by the way, I think the pubs are going to have a really hard time of it. You may not see many pubs reopen at all, which is unfortunate because a lot of businesses are going to really suffer. But so Highsmith says the virus is a con. Yeah. I don't know. Could be. Some of it could be very overstated, but yeah, I don't know. Paul says, I don't think our generation will feel comfortable again. Yeah. One of the things is, Paul, is people have short memories, and maybe in a year when this thing is passed, if it completely is passed or there's a vaccine, then people would feel comfortable. But I think it's going to take time. Tony says, does the voluntary cut in assets direct to salaries by 50% indicate the company is in a dicey position? Should I get out as fast as they will let me? Tony, no, I had about a half an hour Zoom call yesterday with CEO of Assets, Stuart Law, and I don't think they're in a dicey situation. I think they're at break even right now, and they took the cut to really plan forward. And good companies are the ones that are taking necessary precautions like that in advance. And it doesn't necessarily mean that they're in financial trouble. Those forward-looking companies are the ones that I actually would feel more comfortable investing through. So I don't think Assets Capital is in dire straits. Hi, UK Soul from Tokyo. How are things in Tokyo? I wonder what the virus is like down there. Chris says he's had a great experience with LoanPad, had funds from my Classic account in under 24 hours. after my withdrawal request. Very impressed. Yes, LoanPad continues to impress me too. If you want to sign up for a LoanPad account, please do it through my website. It helps me out a lot, and it makes Louis, who is the owner of LoanPad, very happy when guys refer people through to LoanPad. And by the way, just a little credit to Financial Thing readers, and I get this feedback a lot. They say you are some of the most consistent and well-knowledged investors of all the people, and high-quality investors. So kudos to you for that. Let's see. Philip says crowd property projects are still being snapped up at 8%. Can they reduce rates on current deals? Are these rates feasible? As I've noticed, projects have been extended with penalty interest. Crowd property knows what they're doing. I will say that. I don't know about if they can reduce rates on current deals. That would be something we'd have to look at the terms and conditions to see. I think that would be unlikely, but things can be put into terms and conditions and they can be changed at any time. So I would say it's a great question, but I don't think that they could reduce the rates below what you signed up for on an individual deal. Are these rates feasible? Yeah, I think I wouldn't be surprised if the rates started to be reduced. But feasible, it depends on the developers. I mean, a lot of home builders in the UK are starting to revamp their process and start building again. I heard that Wimpy is going to start building. So the UK housing market will remain strong just because of the basic demand and supply problem of there not being enough housing in the UK. So the property sector, one which I was a little bit, before the COVID virus, I was a little concerned about peer-to-peer property lending because we have seen some issues, but I'm starting to think that's probably one of the stable parts of peer-to-peer at the moment. So yeah, I think the rates can be sustained. Let's see what. Yeah, please hit that thumbs up button. By the way, it helps me with the YouTube algorithm. So Peter says, do you know how long the waiting time to withdraw money from assets is? I think it just depends. I don't think there's any particular time that they put on the withdrawals now because it's all based on demand and supply. If there's somebody to buy your loans out, then it's going to go in a queue, and if there's nobody to buy loans out, then the queue stops. So I think you'd be looking at 30 days plus, but I wouldn't be surprised if it was longer. One thing about assets, they are actually working on a secondary market for all of you that are invested in the access loans, the 90-day, 60-day access accounts. They're going to offer a secondary market where people will be able to discount their loan amounts. So if you had, a few £100 invested through the access account, you wanted to exit out quickly, you could discount by a percentage and people could be able to buy your loan amount. So that will certainly increase the liquidity, I think, if people are willing to take a discount to sell out. So that's a piece of good news. I don't know where or when that is going to be inputted into the new system, but it is in the works. Thank you for hitting the thumbs up, everybody. I appreciate that. Let's see what else we got here. David said LoanPad have reduced their access account interest by 0.5%. Is this better than the assets fee idea? It's not better for the investor, but it's better for LoanPad to be able to offer more competitive loan rates through their borrower Hanf capital. Again, hopefully this is temporary. So I don't know that it's any better or worse than the assets fee idea. I think it's just another way to do it for them to stay competitive and to be able to generate revenue. They are a business. All of these businesses do have employees to pay, rent to pay, and they have to keep going and generate fees somehow. So, as long as things are temporary, I don't mind seeing a rate reduction. Happy to, get a 0.5% or 1% cut off my targets for the next 3 or 4 or 5 months if it's going to keep the keep the businesses going. Paul says he's in Portsmouth. One day he'll return home to West Palm Beach, Florida. So, Paul, are you an American or an Englishman? That's interesting. Hi, Colin in the Peak District. Hi, Tim in Lilliput. It's my neck of the woods there in Lilliput. I wonder as to Sultan's Marina. Ken says he's chatting from the Emerald Isle, Ireland. Yes, David, my microphone is impressive. I'm not going to make any jokes about that. Hi, for Alan's in Middlesex. John says, regarding crowd property comments, some crowd lords sticky offers have recently funded also. Confidence returning. I think there's a general, crowd lords. Let me see if you're talking about, let's see, crowd lords. Yeah, I don't really have much comment on crowd lords. It's not a company that's really ever been on my radar. So I don't know. I don't want to give you some wrong information about what's going on inside of them, but so Highsmith says, I must say out of the platform's assets has had very few issues. Yeah, I think assets is handling things well, and they have a pretty nice looking dashboard, by the way, that they've incorporated. And inside the dashboard settings, you can actually turn on your outstanding fee setting to see how much in fees you're being charged through the assets platform. So I like that. Zopa is the worst. Yeah, I'm not a Zopa investor. I think I have 60 pounds and I'm winding down from a few hundred that I had in there, and I definitely wasn't a huge Zopa fan. Zopa, I think, is going to turn into a bank eventually, and will probably slow down with their peer-to-peer lending. I think there's probably more money in it for them as a bank. So Me Too says the haircut for rate setters' interest is taken from investors and put in their provision fund. The borrower still pays the same amount. Yes, you are correct. Rate setter investors are taking that interest rate haircut. I don't know what a rate setter's financial ability is to contribute to that fund, but it would have been nice for rate setter to take a portion of what was coming from the borrower in fees and to put it into the fund. But survival is everything, and if rate setter felt that they needed to do that to keep the platform up and running financially, then they have to pay their employees. They've got a pretty big office space over there and a pretty big headcount of employees to pay. So not generally surprised, a little bit disappointed. Of course, it'd be nice to see rate setter support the fund in a different way. And, to be honest, rate setters, when they drop their interest rates, I became less impressed with the rate setter. I do like the operation and what they're doing. I think the people there are good people, but when you're getting paid 3.5% on unsecured lending, you do start to really question, is it worth it? And I decided that, for me, it wasn't. I started to sort of wind down my loan book with rate setter and to see if better rates would come. I have heard of people manually investing through rate setter who miraculously seem to score, rates that are in the 5 and 6%, but you've got to be on there checking your account. It happens at weird times, sometimes on a Monday, where you're able to manually somehow get rates that are better than they're offering going rates. But I just personally don't have the time to be sitting on rate setter trying to get an extra 0.5 point or 1 basis point more than I'm getting right now. So at the rates that they're offering, even before the rate cut, it just wasn't attractive to me. So I was just taking the interest payments out, not reinvesting. And today I put in a sell order rate setter, which I've never done before. I'm taking the fee. I'm gonna, if I even think that I can exit, I have doubts that I'll be able to even get the money out. But I put a good portion of my 5-year portfolio, which is the legacy product, up for sale. Part of it is a test, so I wanted to see how long it was going to take. I'm still Put in the sell order on the Access account on March 13th. There's still nothing that's come out of there, so I'm presuming that the rate setter exit is going to be a while. Again, I wouldn't fault anybody for wanting to exit. I don't know if the company has financial issues or not. Haven't heard anything that would lead me to think so, but I'm definitely being more cautious with them. Dale says, hard to see anyone investing new money into rates given you can get 1.25% in an FSCS protected savings account. Yeah, I don't think you're going to get 1.25 for too much longer. I've been getting emails from the bank savings accounts saying interest rates are getting cut. I think Marcus or Ford Money said the rate was being cut from 1.25 down to 0.85. I got that email recently, last couple of days. So I think you're going to see savings rates just continuing to fall because of the interest rates. They're not going to be able to pay 1.25% for too much longer. Hannibal says, not good news from rate setter. Is it better news from assets yesterday about their new accreditation? Yes. Let's go ahead and talk about assets. My chat with them yesterday. I think they're very well positioned for COVID. They're running at break even right now, which is great. That fee, even Stuart told me, Stuart's the CEO of the company, he said that they don't really need to take that fee, but they want to just be proactive. And it is going to be a temporary fee, but even without that fee, they're running at break even. That fee, I would imagine, would be probably for the next 3 to 6 months. And they are evaluating it every month to see what's going on, whether they can get rid of it. The CBILS accreditation is good for them. It's enabling them to offer loans from 250,000 to 5 million pounds. And what that does is it's going to create revenue for Assets Capital through origination fees and also through the government paying the first 12 months of interest for those loans. And for you as a retail peer-to-peer lender, that creates stability within Assets Capital, which is a great thing because that's what we need right now. We need companies to be stable. So, and again, why would they want to offer retail loans at this point if they can just do CBILS loans? Assets wants to continue to, number one, service peer-to-peer lenders because they understand that as retail investors, we're the ones that really started the company and we're able to get them to grow to where they have a 400 million pound loan book now. So, Stuart does want to continue to offer peer-to-peer retail loans, and also 50% or more of the CBILS applications will be denied because people don't qualify for what the government is stipulating they need to qualify for. So some of those customers will be able to actually qualify for peer-to-peer lending loans. Couple of different statistics here of assets if you're an investor. So they have a 400 million pound loan book, approximately 55% of the loan book, which equates to be about 280 million pounds of the borrowers have asked for forbearance. So 45% do not need any type of forbearance so far. Obviously, that could change day to day depending on economic conditions, but it's not like 100% of their borrowers are asking for forbearance. So it seems like that's not too bad. I was expecting it to be much higher. So Stuart said 50% of borrowers have asked for forbearance. As far as investors looking to exit, 3% of Assets Capital investors have asked for 100% withdrawal, and 25% are asking for some kind of a partial withdrawal. So, yeah, I definitely expected that it would be more than 3% looking for exits, but that's certainly a good thing. Assets also has very good access to institutional funding lines, which is I do think they're going to be one of the companies that really expands because of this. When you have institutional money behind you, you have access to fill loans. The biggest problem with peer-to-peer lending for a business perspective is having that balance between lenders, investing money and borrowers wanting to borrow. You can never get that balance correct because you just don't know how much demand and supply there is going to be on any given month for borrowing versus lending. Having an institutional line means that they have access to be able to get money, lent out if they need to. Say they can't, fill a loan from a retail side, they might be able to fill it through the institutional lending side. So it gives them a lot of flexibility. I don't think they're not going to go 100% institutional like you've seen Lambay do. I think you'll see somewhere, in the probably 40 to 50% of assets capital being institutional, but they definitely want to continue to service you as a retail peer-to-peer lender. And I think that's going to be a fine place to put your money. I'm certainly leaving my investment there. I'm not increasing it at the moment, not decreasing it. One of the challenges that Assets Capital is having right now is they do a lot of property lending. Percent of their lending now is property. They're not able to meet the valuation companies on site because of the social distancing. So it's becoming a challenge, writing those new property loans, but that will eventually start to level out and they'll be able to continue to write those property loans. As I mentioned, Assets is creating a new secondary market for people invested in the in the access accounts, be able to discount your loan portfolio if you want to access your money quicker. You might take a hit on what your valuation is on it, but if you do need quick access to money, that's probably going to be a good thing for you. I'm not sure how long that's going to take to implement, but hoping soon. And then last but not least, with Assets, I took a quick look at my manual lending loan books. I haven't looked for a couple of months, and I have 63 loans in that manual portfolio, with 16 being in default. 16 loans out of 63 are in default, and 5 of those loans are wind turbines, which they are working on that wind turbine situation. But what's good about Assets Capital is a lot of the loans are making capital and interest payments. So over time, the loan balances are reduced. So even some of the loans that are in default in my portfolio have a drastically reduced capital balance of, I looked at one loan, for example, today that was in default. The original loan amount was £570,000 and the default balance was $277,000. So your loan to value is greatly reduced, and the loan was secured by a residential property that was valued at $900,000. So, you've got, while defaults look bad on paper, you do have some advantages. Assets is reducing the capital balances on some of those loans. So it doesn't quite look so bad because that makes recovery a lot easier. So you might want to take a look at your own loan portfolio. You can download it as a Excel spreadsheet and look at the details. But also, they do have good statistics on personal loan portfolios about how much of the balance is left. If you click on the individual loan, you can see that. So I'm not too concerned about the Assets Capital defaults. So let's see. Just take a look at some of your comments. Dominic says, have you managed to exit RateSetter and get your money back? No, I have not. I put in this sell order on March 13th and have not had anything returned yet. Have had a few capital repayments that I've managed to put into a holding account and withdraw. So, Dale, you're welcome. Thank you for being on this stream. Cano Flow, are you losing video? I hope not. I hope everything's working. Tony says, am I right in thinking Assets Provision Fund is very small considering the anticipated calls on it that may come up in the present circumstances? Yes, you are right in thinking that, Tony. If you go to my review, I do look at the provision fund amounts compared to the loan balances, and yeah, they are small. They're I think in the region of maybe 1 to 2%. They're very small. So that's not one of the advantages of investing through Assets. But Assets is not really a provision-based business model. So the fact that they do have a small provision fund is it's just a little benefit. But they're not like RateSetter, which whole business model is really based around that provision fund. So it's just a little extra funding, but it doesn't cover much. You're right. Hey, Derek in Connecticut. How are you, sir? Annabelle, you're welcome. John, which types of sequence of peer-to-peer loans are likely to be most attractive as lockdown unwinds? I think property loans will be attractive. There's still this shortage of property in the UK. Anything secured is going to be a good. Unsecured, that's hard to say because it depends on unemployment. A lot of people who take unsecured loans are people that tend to lose their jobs or are not in safe job positions, so they could be the first that stop paying on their loans. So I like property, anything that has a reasonable loan to value. That's why I like LoanPad so much, because they do have these very, very low loan to value amounts on their loans. Their average is 26%, right? It's incredibly low. So yeah, I would look at property backed lending being good. Of course, it has its risk like anything, but that I also think that a company like RateSetter may see this massive demand for unsecured lending too. And I think the last time I looked, 20% of RateSetter's portfolio was property based anyway, so they're doing property lending. But you may see a big run on demand for consumer loans, which would benefit RateSetter, especially with fee generation. But it's also risky with the default side of things. So. Also Unbolted, I mentioned last week, something you might want to take a look at. They do the gold, lending on gold, things like that, payday loans on gold. There is a little bit of a moral dilemma with Unbolted for me, because they do charge such a high APR on their loans. It's like in the 40% range APR, but there's that whole ethical lending conversation about, is that ethical and do I support that? And I'm sort of on the fence about that, because I do feel a little uneasy about such high interest rates. But if you're not bothered about that, you might want to take a look at Unbolted. Cufflinks, peer-to-peer, property-backed loans, Lend Invest. They've got some decent loans. And LoanPad, so assets for the business lending. Peter, I think I answered that. I don't know what the assets capital movement time is, because for exiting, I think it's just going to depend on demand and supply. So I'm just scrolling up here. Yeah, if you have questions, pop them in the chat, and I will do my best to answer. Peter said, "Do you know how long the waiting time is to withdraw monies from assets?" I don't. It's demand and supply dependent. I'll test it out next week and see if I can get a reading on how long it takes to get money out. Hey Smith, hi Smith. Yes, I think I agree with you. There will be massive redundancies in the airline industry. People are not going to be hopping on airplanes anytime soon, so it's unfortunate. I don't know how they're going to survive. I really don't. The best advice on the virus: take vitamin D. It's essential for your immune system. Yes, vitamin D, exercise, green tea, matcha powder too. And don't put any disinfectant in your body. You don't want to be listening to Mr. Trump. He's no idea what he's talking about. Semi-lockdown in Tokyo until the end of May, UK Seoul. Yeah. Hopefully you're not living in a tiny little Japanese Tokyo pod. That would be uncomfortable. John says, is it possible to know the precise state of the rate setters provision fund? Yeah, you can look at their statistics page. If you go to my review on rate setter, I have a link to it. I could hunt it down for you right now, but it's not very easy to spot. So just go to my website, financialthing.com, and search for the rate setter review, and it has the provision fund information. I think the fund is 10 million in cash. They got a £4.5 million increase from a bunch of old debt that they sold that was defaulted. And I think they have expectations to be able to receive up to £23 million. And that's obviously going to increase now with this interest rate reduction. So go take a look at that on my website. You can link through to Rate Setter's statistic page. Yeah, but we have to take their word for it, whatever they write. At the end of the day, we can't access their bank account to see if that's the truth, but I believe it to be true. Richard says, what do I think about the rate setter interest haircut? Are they in trouble? I don't know. It's a shame that they're not contributing to the provision fund through borrower origination fees, and that the investors are taking the brunt of that hit. So I'm annoyed about it, but it is what it is. We've got these weird economic times. So thank you, Chica Boy, for saying that. When are you going to report on your visit to Propland? Oh gosh, yeah, I need to do that. I have a book of reports that I still haven't gotten to yet because I've been so busy trying to update all of these reviews for the coronavirus. I thought Propland was just initially, they seem to be very, very experienced. They lend on commercial properties that are income producing, and I got a good feeling about them. So we'll see. I don't have a lot of insider information, but I met with the owner for about an hour and a half, and I generally got a good feeling. I will try to put together a video or some information about that in the next couple of weeks. It's in my book. I just have to get to it. It's on down on the list of things to do. 7-Eleven Honved says, biggest risk to property market is falling incomes and austerity. Developers may be forced to reduce prices to sell. Yeah, and that's true. If the peer-to-peer lending companies have reasonable loan to values, they can, take a reduction in sales price and not get hit too badly. But companies like LoanPad that have these extremely low loan to values are not going to be in as much risk as, say, companies that are offering loans at 75% loan to value. But I could see a 10-15% drop in property prices, but it's just so hard to know. Yes. Hi, Esther. You said assets are introducing a secondary market. I remember reading one of the other peer-to-peer companies has done the opposite by freezing their secondary market. Yeah, there's been a couple that have it. Funding Circle, Growth Street has frozen its ability to let people exit. So there's been a couple. Aki Chap, I'd like to know where I am in the withdrawal queue. Waiting for 7 weeks now. I know, that would be nice. Agreed. I'd like to know too. I think if you saw a queue that said you're 15 weeks from being able to exit, you might get really annoyed. So maybe there's a reason why they're not putting that queue up. I don't think that'll change. So Paul says, do you think we'll ever get any money back from collateral that's in administration? Yeah, I do. I don't know how much money you'll get back. Probably not what you would hope for. It's in administration, and yeah, it's a crappy situation. Nobody's heard anything about the collateral administration for a while now. I don't think they are under any obligation, the administrator, to provide more than one update a year, which is crappy for investors. But I expect, if I had to take a guess, anywhere from 50 to 70% capital loss on that administration, but it's just a guess. Chica Boy says, just to say, with the possible meltdown of the UK economy, I'd be happy to get all of my capital back from 7 peer-to-peer platforms. Yeah. Capital preservation is definitely key. Highsmith says, how is Funding Circle doing? Their Funding Circle is busy loaning CBILS money to businesses and probably getting a lot of borrower fees from that. So I think they're doing okay. Their share price is 84p. I checked today. If you have any Funding Circle shares, put it in the chat. I'd be interested to know, not to ridicule you or anything, but just wondering if anybody does have any Funding Circle shares and why you have them and what price you bought them at. John says assets withdrawal about 20%. You've gotten 20% of your request over 1 month. Well, okay, well, that's some good news. Fitzov de Sullens. That's a great name, Fitzov de Sullens. You sound like some kind of a mid-century author of poetic novels. You say, I've been waiting 9 months to withdraw the remainder of my investments in the business and property accounts. All bad loans now and no response from the provision fund. I don't know what you're referring to, which company fits off. If you can put the company in, that would be helpful. Let's see, Dominic. Where will assets get the money to loan for Corona? Will they loan out of their provision fund? I don't think so. They don't have enough money to loan out of that provision fund. That provision fund is usually from 0.5% to maybe a little bit under 2% of their loan book of that particular fund account. So they've got institutional credit lines that they can turn to. So I don't think they're going to have a problem with where to get the money from. Paul says, if interest rates go negative, do we have to pay the banks to look after our money? Depends. Depends what the banks decide to do. I can't see them going negative, honestly. So I wouldn't worry about that right now. I think I'm just going to remain really low. David said, it all seems all quiet on the funding secure front. I fear that the virus may put pay to any meaningful capital recovery for investors. Yeah, funding secure is a mess. It wasn't good before the virus hit, and I think you'll see some of the recoveries probably just paused for now. I mean, what are the alternatives, right? They can keep pushing forward with recoveries, trying to sell property at fire sale prices, which is going to be a big hit to investors, or they can sit on them and wait. I think you probably see just things being paused, which is going to take recovery is going to take much longer. The administration process. For anybody that's in Lendy, you're also going to see that process is going to continue on for a long time because there's legal action being taken by the investors against the administrator RSM, and you could see that going on next 2 or 3 years. The problem is that RSM believes it has legal rights to take part of the recovery and then distribute it to the creditors. Unfortunately, one of the creditors is Lendy, so RSM believes it's legally okay to take a portion of anything that it recovers and give it to Mr. Liam and the Lendy team, who don't get me started because I'll rant about that. It is just very annoying, frustrating, unforgivable that Lendy would receive any money from any recoveries. Funding Secure also doing exactly the same thing. Personally hope that there's legal action against that too, because I think it's just a travesty. And that goes to show that we really all need to be careful of what are in those terms and conditions of a wind-up plan. If a company does go out of business, do they have rights to access any of that amount that's recovered in an administration? So a problem with terms and conditions is that you can, as a business, add something to the term and conditions, or 1 or 2 lines of information in something that is pages and pages long. You can send out an email notification to investors and say, we've changed our terms and conditions, but who is going to read all of those terms and conditions pages? Who has time? I try to keep up on it. Sometimes I miss things too. Paul says, LendingWorks is retaining all interest, but withdrawal of payments is very quick. Any thoughts? Withdrawal. Obviously, I mean, losing interest is not great, but being able to exit is the key, isn't it? Liquidity, if you need to get out, being able to get that cash out is important. So 50% good, 50% bad. Scott says, is the extension of the lending administration mandate good news for investors or for them only? I think it had to be done. It's not good news in the fact that the administration fees are just going to keep on increasing and increasing the longer that this recovery drags on for. But the problem is you're dealing with properties that are very difficult to liquidate, especially now, and very complicated recovery and administration situations. So it's not good news. I mean, none of it's good news. None of anything administration is bad. The fact it's going to drag on for longer now is bad. The fact that there is going to be legal action taken by investors is bad because it costs money and it's going to hold things up. But I think it was inevitable that it was going to be extended. So it just gives the administrators time to get it completed. They may not get it completed in 3 years. It may take 5. I don't know. I wouldn't be surprised to see a longer extension than that. Peter, any thoughts on Cufflink? Yeah, I think Cufflink is fine. I haven't really changed my investment strategy with them. They're still seeing an inflow of investment money. I haven't really heard much from them. I will reach out this week to get an update, which I'll provide to you next Thursday. But I haven't really heard anything. So nothing good. Sorry, nothing bad. Tony says, first time on your live stream. I'm impressed by your informed, direct, and clear advice. Cheers. Cheers to everybody on the live stream. Thank you for that. I'm definitely not the most articulate person in the world. I and ah and stumble, but I'm trying to get better just to give you as much good value and information as I can. So I appreciate every single one of you here. I do have a lot more information to give you. I just want to be as interactive as possible and answer your questions. Let's see. Paul Bagworth said, landlord invests haven't let me down in 4 years. Okay. Yeah, I don't know. I really don't know much about landlord invest. I think they have a relatively small portfolio, though, if I remember correctly. So, yeah, there's certain levels that peer-to-peer lending companies have to reach in order to be profitable. The magic number is a £10 million loan book. So I don't know what landlord invest's portfolio is like, but could be one to look at. James says death, divorce, and destitution are all bad for property prices. COVID will see all three. Are you sure about property staying strong? No. James, I'm not sure about anything. I'm just giving you my opinion. I think you will see a temporary reduction in a possible downturn in prices, but the fact is that demand and supply is going to be what it is. People need a place to live. There isn't enough housing in the UK. And eventually, over the long run, property prices will be okay and property will be stable. But nothing is as normal right now with COVID. So short term, I'm sure there's going to be bumps in the road with property. But I think there's just too much unknowns at the moment to really get a good, a good analysis of what's happening in the property business. We've only been in this COVID situation now for March, April. Coming on 3 months. It's just not long enough to know what the real impact is yet. Debbie said, rate setters update says they are currently processing release requests for 5-year loans requested 17th of March. 1 year, 16th, 12th of March. Okay, there you go. So you're looking at, according to Debbie, 2 months if you're trying to get out of the accounts. I missed that email. I don't always spot them all, but Chris says, any news on Growth Street? Yes. Growth Street. What do I have? I mean, I don't have any insider information, but just what they sent you if you're an investor on the email, that they have had no borrower defaults because of COVID yet. I highly expect that to change. Surprised actually about that. I would have thought they would have had something come up as a form of a default, but they're not changing their target interest rates, and they've increased their liquidity from 1 million to 3.2 million. Sounds like they're making some proactive decisions to try to change the situation over there, but nothing more than that at the moment. George, hi George in Bridlington. Any comment on British Pearl? All dividends, interest suspended, and properties are to be marketed now despite current market. That certainly is not a good. I never was a British Pearl investor. I did go to meet with them maybe 18 months ago and just didn't really light my fire as a place to invest through. So it's a shame. Yes, Corona could be an excuse for problems in the business. I don't know, but I never felt too comfortable. So Fitzov, you had a question about. Let me go back up and says you've been waiting 9 months to withdraw the remainder of my investments in the business and property accounts. All bad loans now, and no response from the provision fund. Fitzov, that's unfortunate. Usually the provision fund kicks in when there's no other recovery options, I believe, on those accounts. So you may just have to wait. But yeah, provision funds are discretionary, by the way. The directors decide when those provision funds kick in and when they don't. So you may be waiting. That's why you haven't seen any action or you haven't seen any payments from the provision fund because of that. Just be patient. Hopefully you don't have too much of your portfolio in defaulted loans in those accounts. Alan says around 30% of my unbolted loans are well beyond their end date. I guess the moral question arises as they will be selling the security off left, right, and center. Yeah, so good thing is right now gold is seems to be a investment vehicle that people are looking for safety in and will probably be demanded. So if they have gold items that they need to sell off to pay off loans in recovery situations, they're very easy to get rid of. So there you go. That's why I like Unbolted. I get emails every day saying this loan has been sold and you've been repaid this amount from a defaulted loan. So they're easy to liquidate. UK Soul says, I'm looking at buying property in the UK 2021. Do you think cash buyers will be well placed then? I think that I don't know the answer to that question, but I think certainly in the next 6 months, if you're a cash buyer, you're probably going to be able to get some decent deals on property. But 2021, yes, depends when. If you're towards the end of 2021, you might be on the back end of it, but early, probably. Bone broth. How does your breath smell? Are you saying why does one's breath smell, or how do my breath smell? I don't smell anything in particular. Why do you smell something? Okay. Kerno says, what's happening with stocks and shares at the moment, like the S&P 500? What do you foresee going forward? Good question. So there's this massive disconnect between what's going in the stock market and the economy right now. It seems like the two have no correlations to each other. And, you got to wonder why that is. Well, here's the reason I think it's happening that way. If you're a person who works for a company, you have a retirement account, an ISA, or in America, a 401k. And the problem is there's just nowhere else to invest. So you're going to see people continuing to invest through their retirement accounts on a monthly basis, which is just means more funds are coming into equities every month through 401k and retirement accounts. Being that there's no alternative, the stock market is going to see a continued influx of investors. So that's why you're seeing this massive disconnect right now between what's going on. Now, if interest rates were better, say savings accounts were paying 2 or 3 or 4%, or you could get bonds that were paying 5%, you would see a big influx coming out, people exiting equities to go into safety of bonds. But right now, with bond rates being so low, there's just no other place to put money. So, that's why you're seeing this continued discontinued equities going into the S&P 500 and other markets around the world. I don't think that's going to change. A lot of retirement accounts through companies don't even know what they're invested in. And they certainly don't stop investing in 401ks through equities. They don't know when to pause. They don't change their investments. So you're talking mainly, most people are just amateur investors, and so they don't change their 401k settings. Even, I've had some consults with people this past week about, in America, they do things called 401k matches. So they'll match a certain percentage of your salary. And a lot of the companies are stopping the matches right now. So people are saying, well, should I still continue to invest in my retirement account? And I asked them, well, what are you invested in? And a lot of the times they say, well, I don't know. I have a Fidelity account or a Vanguard account, but I have no idea what's in there. I picked it out years ago and I don't touch it. So I think that's why you're seeing this disconnect. People just mainly don't touch their investments because they don't know what they're investing in. They don't know how to adjust things. So. Matthew Carrolley says, with the current conditions as a new investor, would you consider investing in any of the top 5? I'd probably be on the sidelines right now. I don't think there's necessarily a point in taking risk on at the moment, and by investing in peer-to-peer, maybe in a month or two, I'd start looking at the top 5, but I don't see any real reason to be trying to eke out, a portion of a percentage of 2 or 3% over the. Well, I mean, you're talking about if say you go to a company that pays 5%, you're essentially getting, what are we talking about? Less than 0.5%. Over a period of a couple of months. So, what do you really have to gain by taking risk at the moment for low interest rates? Not much. So it also depends on how important that money is to you. If you have money that if you lost it would be devastating to you, then obviously you wouldn't want to risk it by putting it in peer-to-peer. So I'd probably be erring on the side of caution at the moment with peer-to-peer investing in general, just to see what happens over the next month or two. Dominic says Buffett reckons that the S&P 500 is overpriced by 10% at the moment. Do you agree? If he says so, he's a lot more advanced than I am as an investor. I don't know that it necessarily matters that it's overpriced by 10% because people are just going to keep on buying equities because they have no other alternative. So I don't necessarily think it matters whether it was 10% overpriced or 15%. I'd still keep investing. DJ Sam, are you okay to communicate via email? Yes, please send me any emails. You can send the email to help@financialthing.com. Happy to answer your emails. Cash Pat, what are your thoughts on Easy Money? I've tried to get a meeting with them last 2 times I've been in London, and I've had no success. So usually if a company won't meet with me, I'm not so interested in investing through them, but they have a good brand name and they have good backing. So, but I don't know about their products. I usually only discuss companies that I have experience through, and that's not one that I have. Any good stock tips, Paul says. I don't think any company is safe in the stock market now. People are running towards Amazon. Is Amazon a safe place to invest? They have potential problems that could happen to them. But I don't buy individual stocks. Never. The only stock that I've ever owned individually, say in the last 5 years, was Apple, which I sold most of my Apple stock. Buying individual shares is very risky. And speaking of shares, you're going to see dividends being cut too. So they're just going to be less attractive. Index trackers are the way to go. I think they always have been. If you haven't looked at investing in index trackers, please take a look at them. Great book, Little Book of Common Sense Investing by John Bogle. You can find information on my website about it. It's pretty much the best book about index tracking. And I think it's just the easiest. What it does is it stops you making emotional decisions. When you buy individual stocks, if you're somebody that likes to check your stock prices, you start to see things going in a downturn, you panic emotionally, you're going to have that want to try to buy and sell these stocks that you're in and try to, especially if you look at a stock and it's down 30%. Look at some of the airline stocks. They've absolutely taken a massive beating. If you see that your stock's down 60 or 70%, what's the emotional mindset? It's to sell and then try to put that money into something that's invested in. I've experienced that myself. I put in a few $100s in a trading account just as a little experimental test. And my account, I think, is down 40% right now. And emotionally, I keep thinking to myself, I need to sell these stocks and move them into something that is going to be on an upswing. And the problem is with the stock market, the only time you lose money is when you sell. Buying and holding for the long term, unless you're very experienced at trading, is the way to go for most of us investors. That's why I don't like individual stocks. Or if I own one index tracker, 2 index trackers, I don't have to emotionally worry about it. I can just keep investing and forget about it. So I don't have to try to pick stocks. John says, sorry to depress, but how would you see the expected UK tax increase to pay for COVID impacting peer-to-peer in general? Well, tax increases just make people poorer. So, when you're making people poorer through tax increases, you have less money in the economy for people to put into their businesses or to invest or just general consumer spending. So economically, tax increases are not good for your average consumer, which would have a knock-on effect for peer-to-peer, but we'll have to see what happens. You're welcome, Chica Boy. Spend, Paul. Yes. Is there any chance of having the live stream earlier? The reason why I did 8:15 ES is because on Thursdays, people like to go outside at 8 p.m. and bang on their pots and pans for the NHS. So I found this time to be quite convenient. But if there's a general feeling out there that you would like the live stream at a different time, put it in the chat. I'm always open to changing it. It doesn't make any difference to me at all. Okay, so let's have a little chat about let's see what else we have here on my information sheet that I can give you. So we talked about RateSetter and their rate cuts. Obviously not surprising to me, but disappointing they're not funding some of those provision fund amounts themselves, and they're taking the money from investors and putting it at their interest, half of their interest, possibly until the end of 2020 into the provision funds. New investors cannot open an account, and if you're a investor right now, you can still continue forward with them. My main concern with RateSetter is, majority of their loans are unsecured, so they are going to suffer the most, I think, right now. So I'm not too bullish on RateSetter at the moment. Let's see. I think that's about it. One of the things I wanted to discuss too, and we'll probably end the stream shortly, but One of the emails that I'm getting right now is, well, if I don't invest in peer-to-peer, I'm not into the investing in the stock market. Where do I put my money? Should I be investing in the stock market right now? And I think it's a really good question. Is we're all sort of in the same boat right now. There's just not a lot of alternatives. One of my favorite acronyms is TINA, TINA. There is no alternative. Gold is looking like it could be a safe haven for money at the moment, but it's also not easy to buy gold right now. If you go and take a look, try to actually buy physical gold. I don't like these companies that store the gold for you. I think that there's a possibility of fraud that could happen where you think that you own gold and you just don't own anything. So I was going to say, if you buy gold, definitely have that gold with you or in a safe deposit box. Don't buy through a company that says they're going to store gold for you. I just don't trust it. Mini bonds, not a fan. I think they're highly risky. There's also companies, people ask me, like Cedars. People like to buy investments in existing businesses and startups. I think it's inherently risky. If you making any money from Cedars is just very low. So most companies are going to fail within their first 5 years. There's a lot of peer-to-peer companies that get funding through companies like Cedars. And, a lot of these companies are operating at a loss. So you're investing basically in companies that are not making money. So be careful with the Cedars. You got Bitcoin for people that are into crypto. It's a huge gamble, massively volatile. Bitcoin is doing a halving in the next short period of time. I'm not really going to go into crypto, but again, it is risky. Don't invest too much. Incidentally, I looked at Bitcoin when it was about $2.50 back in 2011. One of the guys I was writing a book with at the time said, "Hey, you need to look at Bitcoin." I dismissed it so fast. Of course, kicking myself now, but hindsight is 2020. And then savings accounts, you just got this massive risk of inflation eating up your savings. So really the alternatives now are peer-to-peer. I don't like managed unit trusts at all. I just think you can usually do better yourself investing through index trackers because of the low fees and the low turnovers. Bond funds some people have done well in bond funds, but if those interest rates start to rise, you will see the bond funds perform more poorly. So you do have that as an option. But aside of that, there's just not that many places to invest at the moment. And I think long-term options are really the stock market at the moment. Of course, there's people that are day trading and doing things like that, but unless you have a lot of experience with that, it can be a lot of similar to gambling. So be careful with that. Okay. Dominic, what about iShares physical gold share ETF? You can go that way. Gold can be actually very volatile too. So don't think that it's necessarily that safe. If you look at charts of gold, it has been on the rise since the big drop of the 1980s, but that's all about market timing. If you get in at the right time in gold, it can be a stable asset, but we've also seen big drops in gold over the last, through the decades, 70s and 80s and 90s. So I don't think it would be bad to diversify into the gold share ETF, but it's not something I invest in. I would prefer to hold some physical gold and probably replacement of cash. That ETF has never been something that I would want to put too much money into. David says, stick with the stock market. If you can spare the cash, don't stop investing in tracker funds, folks. Yes, that is wise advice. Don't try to time the market. I have tried to time the market before, and I can tell you I'm usually on the wrong end of the timing. I'm doing some experimenting now just for my own interest and to report back to readers a Financial Thing about some market timing I'm trying right now, and I have a feeling that I will be on the wrong end of that at some point. So But I won't know probably for a year or so what's going to happen. But I would advise for your average investor just to stay invested. Don't be moving in and out of the markets because you'll never know when the highs and the lows are. Stay invested. Keep on investing when you can. Buy through the highs and the lows, and on average, you'll be fine. There's a very interesting article about this I found on Reddit, which I will post in. I'll probably send it out on the email list because it is really quite fascinating about trying to time the market and how somebody who just kept on buying and buying and buying, it didn't sell, fed, versus somebody that knew exactly when the right time to buy was, and the person that got the timing completely wrong. The difference between the person that got the timing 100% right and the person that kept investing through and buying and holding was quite different. The person that bought and held and continued did far better than the person that got the timing right 100%, during like the crashes. So it was interesting. Let's see here. Did Paul says sit tight, cash seems as always to be king. Is it though, Paul? Is cash king? With inflation eating away at your cash, it's not as safe as you think, especially long term. Short term, you'd be okay with it, but long term, you don't want to be sitting on a lot of cash. Martin, guess you wouldn't recommend investing in bleach. You could buy a bleach factory in China, maybe. Let's see. Yeah, you're welcome. Okay, so I think that's it for this week. We've almost been running for 90 minutes. My throat is sore. But do me a favor, subscribe to the YouTube channel if you can. My goal is to get it to 1,000 subscribers in the next 3 months. So if you can share the channel with your friends and family, I would just greatly appreciate that. Also, join the Facebook group. Let me put the link in for you here. Hang on one second. Please join our Facebook group. We're going to have some really good chats on the Facebook about what's going on. Here's another link I wanted to share. I forgot to. If you want to get COVID information from RateSetter, they have a web page that will give you the latest up-to-date information on the COVID. Please join the Facebook group. Hit the subscribe button on the YouTube channel. I will see you next Thursday, and thank you ever so much for your support. I appreciate it. If you have any questions, just drop them on the email, help@financialthing.com, or put them in the chat, or save them for next week, and then we'll discuss them then. I'll see if there's any other questions. Lotterus Wing says, Democrats have unlimited free stuff for illegals in New York, but tell citizens there is not enough supply. They could still import refugees. The high taxes are to do green energy graft or bribe foreigners. Yeah, I'm not a big fan of politicians, so I try to stay away from the political talk. All I know is they tax me a lot every year and don't do much for me, and I pay enough tax in the UK. So, but good insight. Thank you for that, Lotterer Swing. Thank you for joining the Facebook group, David. And Derek says, looks like another curbside meal with the wife. Hopefully you buy her something nice. Anyway, you guys have a great week. Enjoy your weekend. Be safe. Be healthy. Remember, there's more to life than money and investing. Get out there and enjoy yourself. And I'll see you next week. Take care.